When like click on the let's go. So for taxation, two things are involved in taxation. How many things? Everything I talk about involve two. Now, under investment appraisal, there will be two treatments of tax. This is what I mean. Under investment, the operations to create revenue, the operations to create. Are you getting me? Yes. So you have tax at that part. Number two, if you are taking up a project, you spend on PPE. You are either buying plants, or you are buying machine, or you are buying cars that are related to those projects. Is that okay? These are PPEs. And because you are spending money on qualifying capital assets, you have capital allowance. And capital allowance will lead to reduction in your tax. So number one is you will pay tax for your operations on the profit you make from your operations. Number two, there will be tax savings as a result of your expenditures on capital assets. Are you getting me? These two are tax-related issues. Two things. For your tax savings, because that is actually the crux of the matter. For your profit, they will tell you tax is 30%, tax is 25%. With that percentage, you'll be able to know the tax you will pay on the profit you make. Fine. That profit for now, I'm calling it net sales. Okay, that's no issue. The issue is on tax savings. For you to get tax savings, you need to get capital allowance. As far as this cost is concerned, we are not calling capital allowance. We are calling it tax allowable depreciation. We are calling it what? Tax allowable depreciation. And that's TAD, because in the question in the exam, that's what we call it, tax allowable depreciation, TAD. So when I say tax allowable depreciation, you know that we are talking about capital allowance. Correct. That is where it is. To get your TAD, like depreciation, you are using two methods. You are either using straight line method, or what? Reducing balance method. I'm not writing with that. It's not an elementary class. You are okay. Welcome, elementary students. Okay. So we have what? Straight line method and what? Reducing balance method. Two things. So as far as there are other methods for depreciation, but as far as this is concerned, but generally what most believe is one of these. So we are using straight line or what? Using balance method. Under straight line method, as you know, generally, so we are considering straight line method. Under straight line method, tax allowance, let me just say generally, depreciation. Generally, depreciation has not come to tax allowable depreciation. Depreciation is equal to what? Depreciation is what under straight line method?
Cost minus value. Over numbers of units.
Cost minus scrap value. All over useful life. If you say you are buying this phone for 200,000, you will use it for 5 years, and you expect the scrap value to be 50,000. You bought it for how much? People are not paying attention. You bought it for how much? 200,000. You use it for how many years? 5 years. And you sell it for how much? 50,000. What is the value that will drop on this asset on an annual basis? That is the depreciation. Now, it is 200 minus what? 50. Divided by what? 5. 150 divided by what? 5. And that will be what? 30,000. Do you understand the idiom? That is the annual depreciation. Are we there? That is the conventional way of going about depreciation. But that is what it is. I will tell you something different on our learn meetings. Now, for tax allowable depreciation, you use under straight line method, tax allowable depreciation under straight line method. Where there is balancing adjustment, take note. Where there is balancing adjustment, you are TAD, tax allowable depreciation. Are we there? Should be computed as where there is what? Balancing what? Today we will go ahead balancing adjustment under tax. Don't worry if you do not hear, I will still tell you. But just take this one as I'm telling you. Where there is what? Balancing adjustment. You are TAD, tax allowable depreciation, should be equal to cost all over useful life. Here are full stop. I deliberately put full stop. Where there is what? Balancing adjustment. The tax allowable depreciation should be equal to cost divided by are we there? Where there is no balancing adjustment, you will know when there is balancing adjustment in the equation. I will tell you what to make you to know. Where there is no balancing adjustment, this is with what? Balancing adjustment. Where there is no balancing adjustment, TAD should be equal to what you know before. Cost minus what? Scrap value all over useful life. In examination, the examiner will tell you about balancing adjustment. If you are balancing adjustment, if you want to do work on balancing adjustment, I get things. Now, so what balancing adjustment will do is balancing adjustment will give rise to two things. Balancing adjustment will give rise to what? Two things. These are balancing adjustment will give rise to balancing charge or not and balancing allowance. Most times, your examiner will not tell you whether it's balancing charge or balancing allowance. You will look at the scenario. He will just tell you to make balancing adjustment. So you will now look at the scenario to know whether it is balancing charge or balancing what? What is balancing? adjustment. Then what is charge? And what is what? Allowance. Remember, this TAD is coming in place of capital allowance. Capital allowance is coming because you bought a qualifying capital what? Assets. Are we there? You have anticipated that I bought this equipment, let's say block molding machine. When I bought it for 2 million naira. Are you getting me? Yes. You bought it for how much?
2 million.
Government say fine. And you said you will use it for X years, let's say 5 years. Five. Government say fine. And you use it. After using it for 5 years, what is the scrap value? 0. Because each year is 400,000, 400,000, 400,000, 400,000. Correct. Government is fine. But you bought a block molding machine, and after 4 years, you now want to sell the block molding machine that you have told government that the value will be what? 0. And because you said the value will be 0, they allowed you, okay, take 400, take 400, take 400, take 400. Now that they are giving you 400, and now something that is worth 0, you have sold it for 500,000. Government will say, this entire 500,000 you got from it is profit. Are you getting me? Yes. The entire 500,000 you got, not even part of it, is what? Profit. Because by virtue of your own declaration, ab initio, we have allowed you to take off 400, 400, 400, 400. Now you have made profit. You have sold that thing that you said would be 0, and you now sold it for what? Something. And you have not got 500. They will not tax that what? 500. They will not take the 500. They will apply the tax rate on that 500 and take their own part of that what? 500. That is balancing what? Charge. Charge is when they come and they take from you. That is charge. So balancing charge is the tax you pay for disposing a qualified capital asset for an amount that is higher than the tax written down value. The tax written down value. I know they look from anywhere to talk about. So if I tell you, make I tell you now, I will tell you different thing altogether. But now the same thing I will tell you. So I said for what? Disposing what? Okay, you can put it another way. It just means that the sales proceeds of a qualified capital, the sales proceeds of a qualifying capital what? Asset is greater than it was tax received value. Sales proceeds, you are selling it for. So that difference will be subjected to tax called balancing what? Charge. You get it? Me, I believe in explanation, not the definition. Go and define it your own way. So that is it about balancing what? Charge. The next is balancing what? Balancing allowance. Flip it. Oh, you bought an asset. You told government. You even tell them in advance that the scrap value will be, let's say, 80,000 naira. The scrap value will be what? 80,000. Then, when the useful life came to an end and you want to sell it, you sold it for, let's say, 20,000 naira. Have you gained or have you lost? Yes. You've lost. Because initially, the capital allowance you were granted was based on the 80,000. So you have lost. You've lost how much? 60. Because you made a loss, government will say a proportion of that will be allowed you. Called balancing what? Allowance. It's like a relief. They will give you, in quotes, a relief, depending on the proportion of the tax rate. So that is balancing what? Allowance. Let me just look at the material I have. So I have two lines explanation for these things in the material. Me, I know they like plenty talk. Although people they say I do the talk. Balancing allowance is the tax relief given to a taxpayer for selling a qualifying asset lower than the carrying what amount or tax written down value. You dey for your book, you dey for that material. You dey for that material. Balancing charge is additional tax a taxpayer pays for selling an asset above its tax written down what value. You sell them above the tax written down value. The sales proceeds higher than the tax written down value. So let's take a simple question. What's in the time?
7 o'clock.
So given what the time is, I would say we just terminate our classes for now. When next week we will continue.
Balancing charge. Thank you, sir.
Right?